Now, let's discuss the difference between the pre-money valuation and post-money valuation and link these concepts to the concept that we have just explained, which is the difference between the enterprise value and the equity value. Now, let's take a short example. Assume that you have a company now, and you put some capital and you have some investors, so all of you have some equity in this company. How much equity? We assume that the equity is $10 million, for example. $10 million, for example. So this is the market value of the equity. This is how many number of shares times the market share price. So this is the total value of the equity as per the market price. And because you don't have any debt, this is assumption that I don't have any debt and I don't have any cash, so the same value will be for the enterprise value as well. Because you know, when we explained here the difference between the enterprise value and the equity value, we explained that if you don't have any debt or any non-controlling interest or any preferred shares or any cash, so the enterprise value will be exactly the same value of the equity value. So here, because you don't have any debt, any cash, any preferred shareholders, or any non-controlling interest, so the value of the equity will be exactly the same value of the enterprise value. So now, assume that you have a 1 million shares outstanding. So how much equity? 10 million. And how many shares outstanding? It's 1 million. So if you divided the 10 million by the 1 million share outstanding, so you will be able to reach to the market share price, which is $10. This is the market share price for one share type. How much now the founder shares outstanding? Assume that myself as a founder, I have 400,000 shares. So what is your ownership percentage? Simply you are going to divide the 400,000 shares by the 1 million shares outstanding, so you have a 40% ownership in this business as a founder, and the remaining 60% may be to other investors. Okay, so now let's assume that you are going to launch a new round of investment, so you are going to offer investment for a new investor. Okay, so now you are going to say that I would like to get 2 million additional investment. So you found investor, and this investor is going to pay you this 2 million as a cash. So the investor is going to pay cash is 2 million, and against that, definitely you are going to give him 2 million exactly figure for the equity. So he will be participating in the company, and by giving him equity 2 million. Let's now calculate how many number of shares this new investor will receive as a result of his investment. Simply, you are going to divide the 2 million he is going to give you by the market share price, which is $10 today. So you are going to give him 200,000 shares for the new investor. Fine. Let's now calculate the post-money valuation. The post-money valuation. Let's start with the enterprise value. The enterprise value will be the same, 10 million. And the cash will be increased by 2 million. And the debt, now that we have. So how much is the equity value? The equity value will be 10 plus 2 million. So the equity value will be 12 million. And from another different way, if you would like to calculate the enterprise value, knowing that you have equity value 12 million, so let's here use this formula. The enterprise value equal equity value. How much is the equity value? Actually, the equity value is 12 million. Good. How much is your cash? My cash, actually, it is 2 million. And the cash will be deducted. So you are going to say 12 million minus the 2 millions, which is available cash. So the remaining will be the enterprise value, which is 10 million here. Okay, clear. So now it is not necessarily that enterprise value equal the equity value. The enterprise value, this is the total value of your organization. Clear. Now, how many shares overall will be outstanding after the new investment? You are going to consider that I have 1 million plus the 200,000, so it will be 1,200,000 shares outstanding after the new round of the investment. Okay, now how about the share price? The share price will be the same share price, because you are going to divide the equity, which is 12 million, by the 1,200,000. So the share price will be the same, $10. So the share price will be the same, $10. Clear. How about the founder shares? The question here is, the founder shares outstanding, is it going to be changed? It was 400,000. It will be the same 400,000 or something different? It will be the same 400,000. So because actually he didn't sell from his share, so he will be having the same 400,000 shares. But the concept is, how about his value? Is it changed? No, the value will be the same. 400,000, the share price is $10, so he will be having $4 million as an investment in as a participation in the equity. But the big question here is, how about the founder's ownership percentage after the new round of the investment? Do you think that it will be changing? The answer is yes, it will be changing. Why? Because you asked a new investor to enter in the investment, to enter in the business, and you give him additional shares. So your ownership percentage will be starting to decline. So how much is your percentage of ownership after this round of the investment? Simply, you are going to divide 400,000 shares that you have by the total shares outstanding after the investment, which is 1,200,000. So it will be 33% after the investment. Now let's come to the facts. At each round of the investment, the ownership percentage of the early investors or of the founders will be start to be diluted, will be start to declining. Why? Because you are issuing new shares. That's why we can find some investors or some angel investors or some venture capitalists are setting one of the conditions in the term sheet: don't issue new shares unless you present it to us so we can check our availability if we are going to participate in this investment or not. Why they are putting this condition in the term sheet? Actually, because they would like to maintain themselves on the same level of the ownership that they have participated in the beginning. Ownership, I mean ownership percentage. I hope the difference now is clear between the pre-money valuation and the post-money valuation. Post-money valuation, this is the value of pre-money plus the new investment. Pre-money valuation, this is the valuation before taking any new investment. And the post-money, this is the pre-money plus the new investment. I hope it's clear. If you have any comments or any questions, just mention in the comments and I will be able to reply to you, inshallah. Thank you.